Good morning and a warm welcome to the Colliers webinar. For those who do not know me, my name is Len Rosso and I head up the industrial and logistics sector for Colliers in the UK. I think the first thing to say, I think actually the performance for 2023 has been very solid for the big shed market, taking into account the global slowdown. Obviously, occupiers are tightening the belts, and I'm very interested to hear from what Kevin's got to say shortly. But our view is this is no surprise. And if you look at the performance for 2023 to date, we think it's going to end up for 2023 between 20 and 22 million square feet, which is a little bit below the 10-year average, excluding the COVID years, which, we believe to be a strong performance. I think for 2024, our prediction is it's going to be a similar year in 2024. There are going to be a few things which will affect that, but 2024, we believe, will be a very similar take-up in 24 to what it is going to be in 23, which is going to be, in our opinion, 20 to 22 million square feet.
So this year is going to be a record level for spec deliveries, but the market has already absorbed the great majority of it in terms, of course, either being let or be in our supply figures. So Len, can you tell us a little bit more on your view as to why construction starts are slowing as shown by our chart?
Well, I think obviously one of the key reasons is the shift in the yield, which has happened due to obviously interest rates going up and obviously the global and the UK slowdown. It's very difficult to make a spec funding work with the yields move so sharply. That's one of the key reasons. I think the other reason is why 23 was such a big year for spec or construction happening was it's a slight overhang from the COVID and 2022 years, 2022, where basically developers had committed and they'd literally press a button on it. And because of that, there was a slight hangover.
Because of better than expected rental growth seen this year coming through over the first 3 quarters of 2023, we actually upgraded our forecast. And we now believe that UK average rental growth will be in between 6 and 6.5% for 2023, which is an astonishing result considering what's going on in different sectors in the economy globally, which has been impacted demand. So looking ahead into 2024, with the currently suppressed attitude to speculative funding, as mentioned by Len, there'll be lower level of new schemes coming online, which will, of course, sustain rental growth over the next few years.
Wonderful. Thank you very much, Len and Andrea. Super interesting canter through there. So yes, as Len said, I am Jessica Middleton-Pugh. I also write about residential and retail at React News. So just wanted to kick off first off with you, Kevin. Obviously, DHL, you are such a vast occupier. We're really keen to hear how you are dealing with, to be honest, what might seem like a myriad of challenges that have been touched on. We've got slower retail sales, economic uncertainty, ESG targets, and those rising fit-out costs. So I'm just interested in hearing on your real estate strategy and how you're dealing with some of those.
Good morning, everyone. First of all, thanks for the invite to this to give the occupier's viewpoint. The honest answer, it's very tough at this present time on all divisions. I think if we talk about the parcels businesses, they've seen a flatlining of all the demand that's required from the last couple of years, etc., which is meaning that they're trying to work out their growth aspirations and where they have to be going forward, which has meant that certain projects which were to renew and replace sites as we move forward have been sort of put on hold a little bit while we just pause and put the foot on the ball. And I think there is still going to be changes occurring within that portfolio, in particular to get to newer and bigger sites. It's just that people, as I say, are taking a bit longer to make those decisions. The 3PL market is really tough at present. I think the reality is we, with a lot of our colleagues in the business, have got grey space, which is starting to hurt. And that is also driving the view that we've got to seriously look at how we sweat our assets. And our customers are sweating their assets, making us sweat their assets to keep the cost really tight and find even more optimization within our warehouses with regard to making things work better, more efficiently for less money. But it also it touches on the fact that some of our properties we are now seeing are a bit long in the tooth. And the reality is within DHL, as I think most people have heard me batter on it before, we are going through a complete change about the quality of the buildings we have. And ESG is absolutely critical to that. Now, when we look at a property, we have 20 levers that we look at on a building, but there is definitely a movement for us to get out of more older buildings into newer buildings, because it's a corporate driver for us to look at our ESG targets and our carbon footprint.
Yeah, I agree with you. You know, I think occupiers and landlords are now more aligned in green initiatives than they've ever been. I think what we've seen over the last few years is the kind of the payback become much clearer on the landlord investor side. So, you know, Kevin, maybe you disagree with me, but we are generally seeing in the market that if you can provide buildings which are more efficient, so, you know, from an operational perspective in terms of modern specifications, clear height stock doors, but also more sustainable, so can create lower overhead costs. If those attributes to the building can actually reduce the overheads of the occupier, then what we're actually starting to see is an occupier willing to pay more rent for those buildings because the global occupational cost is actually reduced. We're seeing, I think, a real bifurcation of the market, similar to what you've seen in the office market for the last 10 years, where modern sustainable buildings are now attracting higher rents and tighter yields, and older buildings without those are starting to suffer. I think where we stand today, it's a premium, but I would assume that over time, it's really going to switch, which is that the secondary assets will command a pretty material discount.
Enough talk about what we think occupiers want. Hopefully any occupiers in the audience can actually tell us what they want, or anyone who represents occupiers can guess. So what would occupiers in general prioritize when looking to take up new space? ESG credentials, location to access talent, minimal capex expenditure, or lease flexibility. Sadly, you cannot pick all of them, or I'm sure occupiers like Kevin would like to. Curious on this actually, Kevin, while the audience are answering, if you could pick one of those four, which would you pick?
My instinct is it depends on the type of building. If we're looking for a new site, then location and ESG will be critical. If we're looking at existing sites at this present time, lease flexibility, because we don't know what's in the future. And it depends also on whether the landlord is going to commit to the site, because we'll be sitting there saying, in some respects, if the landlord won't invest in the property, we've got to look about investing in it, because we can't take buildings going forward which aren't going to meet our global expectation. But, you know, as you say, I would like all of them at present, but I've got to be realistic.
So who can we get the results of the poll, please? Let's see what's at the top of the audience list. That's really interesting. So the majority was access to talent, which I always think is very interesting in these discussions. And I do think it's true across property sectors that we can spend so long talking about the actual bricks and mortar, or concrete and metal. And in fact, it's the people, the talents that keep the business going. So location also. That's really interesting. Thank you, audience, and a strong response there. So all of these factors, I think, do come into play when we're talking about rental growth. As we heard from Len and Andrea, still a positive picture around that. Ed, what's your view about that? Do we think this rental growth picture is going to continue into next year and beyond?
I think rental growth across Europe will continue. The vacancy rates, for example, in just picking out contextually in Munich is at 0.1%, and in other parts of Europe it's much higher, but the UK is around the average sort of vacancy rate, so it's in a stable position. It's just the access to the right product. I mean, you just heard it from Kevin, getting hold of the right buildings in the right location to the specification they need to be efficient. and their responsibility as obviously businesses is just tight. And so I think naturally the economics come out that the rental growth will continue. We've just obviously heard that the inflationary rate across Europe has come down to 2.9%. It's at 6.7% for the UK. We're expecting that to come down a little bit. That obviously is helpful, and typically rents are a hedge for inflation. And you've seen the results from obviously Len and Andrea's presentation that rental growth here this year is 6.9% and 4.5% moving forwards, which is obviously significantly better than the other sectors. So I think it will continue, but as you see the story, it will be less aggressive. It's sort of more normal levels, if you will. At pre-COVID levels, we saw rents going absolutely sky high in parts. So I think it will continue, but it won't be as much as what we used to before.
Obviously, always important bringing in the actual occupier when we're talking about rental growth levels, because this is particularly pertinent to you, Kevin.
I think the key fact is that there has to be a bit of stability in the market, because what we have got is really quite challenging times. And I'm seeing rents that after a 5-year review pattern are going up 50%. And we have obviously got big hits coming in. We've got business rates that are coming in that have actually come significantly to businesses. And the rents that are coming in are quite painful. And we're big enough that we can pay them. The rents, I say, I would like to get back to a more normal basis. And I want the balance of demand and supply to get there. There are key areas in certain parts of the country where that just isn't happening, and it means that the landlords have the positive aspect from that. And we know the southeast is definitely a painful area. Nobody minds everyone making a bit of profit, but at this present time, we're getting squeezed by our customers. Our customers are becoming more demanding. They're obviously looking to protect their profits, and that means we are a supplier to some of the big customers, and they're saying we want this, improved buildings, we want more efficiency, we want better optimization. What are you doing about it? So let's have an adult conversation. To get to the crux of it, we think that the incentives being offered recently have been very miserable. I think we should be getting back to the normality of where 1 month per 1 year rent should be the basis of that. And I'm not going to have a dig at agents, but I think you've had it good for a long time, not having to do much. Now you're going to have to earn your corn and basically come up and be imaginative to make the deals happen. And that means think outside the box, come and talk to parties like us and say, look, let's be positive. What can we do to help you to get this deal over the line?
I think what's been a nice theme about this webinar is that conversation about increased collaboration between the investor and the occupier, because if you don't both make a good deal, these great deals aren't going to happen.
I think when we meet with what we call customers, our tenants, we generally like a proactive approach. So can those incentives, rather than being in the form of rent-free, be in the form of investment into the property, which helps the tenant in terms of their long-term occupational costs? So I generally think, look, the business doesn't work if the occupiers can't pay their rent and the buildings are vacant. So I think people need to come together and be collaborative and create solutions that work for all parties.
What's your appetite at Clarion in terms of investment across the industrial and logistics sector going into next year, given that more challenging debt picture?
I think what's stopping investors generally from jumping back into the investment market, and why that investment volume is so subdued, is not necessarily the increase in interest rates, but more the volatility of where that's going to be going forward. I think if we sat here today and the world agreed that we're going to stay at a 5% interest rate for the next 10 years, you'd see that investment market start churning very quickly. It's really just the volatility, which I think is anemic to the growth of people wanting to deploy capital. If we go back to Andrea's slide on rental growth, I think those rates were kind of nominal, and you can see that actually logistics is really the only asset class that has rental growth that's predicted to beat inflation over the next 5 years. That's a very compelling investment thesis. So I have no doubt that when stability comes, we'll get back to normal, but it'll be a new normal. Yields have risen dramatically. I don't expect them to come down very quickly. And I think people will be comfortable with that.
I can sort of give a bit of a figure to Rory's point about top stock pick for industrial. So we launched a global investor outlook report last year. 60% of the investors said INL was the top pick in real estate. We've just done we're launching out the new one now, and that's got a very good attendance, and we're already seeing signs that actually logistics industrial will remain the top stock pick by a significant margin. And the point being as well is the players are changing. I think that's another thing to talk about. If you rewind back a few years ago, it was very, very debt driven. To Rory's point, the swap rate cost of debt was significantly cheaper then, and so you're now getting sort of the buyers who take those 10-year horizon views, who go through those cycles, starting to get market share and start to trade in the market. And I think we're also seeing a sign that actually it's consolidating into a fewer players. So the bigger chaps are getting bigger, and there's other parties that are sort of not getting as much market share.
Can I get the second polling question, please? Finding out the audience predictions in terms of the segments of the market in which we will expect the greatest investor returns next year. So looking forward to 2024, in which segment do you predict the greatest investor returns? Multi-let, mid-box, or big box? Ed, what do you think?
I think there's merits in all those three spaces, and actually I'd say there's also a lot of interest in open storage as another sector that's particularly a flavour for a number of investors, and even some inquiries in cold stores. But if I was to pick one sector at the moment, I'd say sort of the mid-box urban logistics. Certainly urban logistics has got a bit of interest across investors for the reasons we all know.
Great, let's find out what the audience has to say when we get the results. I always feel like a game show host in this moment. Okay, relatively balanced, but a slight bias towards mid-box urban logistics, as you were saying, Ed. You know, how resilient do you think the industrial logistics sector is into next year? And, you know, just to avoid endless positivity, what more do you think needs to come out of the sector?
I think more flexibility needs to come into the market. And the respect is not just on leases, but I was talking to Edward a while ago, and he deals with Europe. And what surprises me is that some of the European type buildings haven't actually come across here yet, whereby you take a big warehouse, it's managed by a landlord, and then he can subdivide the building to give the tenants more flexibility as they grow and expand, etc. And we haven't adopted that. We have still very traditional, you get a multi-user site, but it doesn't give you the same flexibility. And I worked in Europe for a while, and I thought the model there was quite good.
It's interesting, almost WeWork for industrial, if WeWork isn't considered a dirty word, considering how it's looking for that. Rory, your view, you know, not only your view as an investor, obviously you've touched on talking to various other investors. You think that we're going to continue to see this level of resilience in the sector into next year? And what more would you like to see?
Yeah, look, I think industrial and logistics sector is resilient, but it's not invincible, right? We've seen it take knocks due to the wider economic situation. I think there's geopolitical risks, which I think can cause contagion. So I think it's in a delicate state right now. Every few weeks we see economic data come out, which I think really sways not only investor appetite for buying stock, but also occupiers in terms of what they want to take up. So generally, I think we're kind of finely balanced. You know, I do think as we look across Europe as a whole, the UK, and when we talk to other investors as well, they agree the UK appears the most attractive because it has repriced the quickest and at the largest magnitude. And all over Europe, including the UK, we've seen a lot of rental growth over the last few years. And so a lot of these leases that have been signed over those periods have implicit reversion. When you look across the landscape, the UK real estate investment market, particularly on the logistics side, just looks much more attractive because of those two big points.
Amen. Thank you for that positive ending there, Rory. And thank you so much to my wonderful panelists. You've all been super interesting, super insightful. So thank you to Ed, Rory, and Kevin. And thank you, Andrea, for your opening presentation. So I'd now like to hand back over to Len for your closing comments and to see us all off for the afternoon.
Jessica, thank you. Firstly, I want to say thanks to audience taking time out of their busy schedules to listen to us. A huge thank to the panelists, yourself, Jessica, Rory, Kevin, and Ed. Really appreciate you taking the time to come to a webinar, and thanks a lot. And we look forward to seeing you all at our next webinar. Thank you very much.